If you clicked on this video, it's because all the trading strategies you've learned on YouTube just don't work. I'm sharing with you a scalping strategy that's kept secret by professional traders. It's easy to understand, easy to use, and it gets incredible results. I'm on the 2-minute time frame on gold, and the first step is to set up the setup. You can easily see a huge support here and a strong resistance up there. For this strategy, we're going to follow the trend. So, even though we're on the 2-minute time frame, we're going to pay attention to the higher time frames. You need to be trading in the same direction as the higher time frame, like the daily chart here. You can see that the market is very bullish. So what we're going to do is look for buying opportunities on the lower time frames in our scalping strategy. The only technical indicator we're going to use for this strategy is the moving average with this period. We'll set it to yellow so it's clearly visible on the screen. That's the only indicator I use for this strategy. Then I'll use price action, of course. So you know that the main trend is bullish. And here, you can see a market pullback on the 2-minute chart. This support price zone is very interesting because, as you can see, it stopped the market here before we finally broke above it, retested it, and confirmed it as support. So, now that the market has come back to our price zone, as traders and with this scalping strategy, we're going to pay close attention for a potential buy with the right signals. And I'm going to explain the role of this 7-period moving average to you right now. We're going to wait for a breakout above the 7-period moving average. You can see that this just happened right here. At the close of this 2-minute candle, we moved back above the 7-period moving average. Generally, when we're below it, it's bearish. When we're above it, it's bullish. So what we're interested in is this breakout to get back into a buy position. The breakout needs to happen with a very clear signal. For example, an engulfing candle like this one. You can see that the 2-minute candle completely engulfs the previous candles. So this is a great buy signal on the support. It shows that buyers are determined to defend this support. You have a first trade opportunity here. You enter at the close of the 2-minute candle, right there. You set your stop loss below the wicks, and for your first target, you'll aim for the last price zone that blocked this price area. This gives you an excellent risk-reward ratio, and just like that, you already have your first trade. Next, you let the market do its thing. You can see that it makes a retracement. What's interesting to do here is, since the market has dropped back below the 7-period moving average, you can see the prices, the Japanese candlesticks, are below the yellow 7-period moving average. We're going to wait for the price to move back above this moving average before buying again. We'll also use, for example, Fibonacci and wait for a very interesting support level. You can see here that the market, look, bounced off the 50% Fibonacci retracement. And as soon as we have this price action, we'll wait for the break of this small resistance on the 2-minute time frame. And once the market breaks this resistance, we can get back in on the buy side to target the second price zone here. You can see that the market broke through the small resistance. The signal is given. We buy again, exactly at this spot. We're going to target this resistance. So at most, our target is in this price zone, and the stop loss is set just below the wicks, just below the 50% Fibonacci retracement. You can see that the market hits the target once again. The advantage of this strategy is that you enter at the beginning of the move, like we did in the first example here, and then you can ride the trend, take advantage of the bullish waves to reposition yourself for buying with the right signals in the right price zones. Let's see what the market does next. We see that it goes slightly higher. There's a resistance. The market hesitates and ends up pulling back a little. Once we see this small bearish retracement, we use Fibonacci again. We take the low point of the last upward move up to 0.0 here, and we can see that the market stops at the 61.8% Fibonacci retracement, which is an excellent level to buy again if, of course, the price action gives the right signals. The price action here does give the right signals because, as you can see, with this 2-minute candle, we break above the 7-period moving average and turn bullish again. So, as always, that means a stop loss just below the latest wicks. And for the target, we're going to aim for a new 0.0. You can see that the risk-reward is excellent. With this strategy, that's very important for your money management. Let's see what the market does next. It goes up. We have a bullish move and the target is reached with a new 0.0. First step, you add the technical indicator. Next, we go into the settings to make a few changes. You can delete 55 and type in 50. Then you click on the style category. You can change the colors of the Bollinger Bands. You can delete that. This technical indicator will offer you a day trading strategy based on Bollinger Band breakouts. Every time prices break out of the Bollinger Bands, it'll offer a sell opportunity or a buy opportunity. You have the upper Bollinger Band, the lower Bollinger Band, and the middle line, which will help us detect trend reversals and trading opportunities. You can see, for example, that it goes from red to green, then turns red again. You'll see it later in the video. I'm going to explain how this technical indicator works. And pay close attention because I've been able to do many tests and it's really very effective. We'll let the candlesticks roll and I'll explain the day trading strategy that I'm sharing with you today. You can see here that the technical indicator is given a sell signal. First, you can see that the middle line was green because the market was bullish, and it just turned red at the same time the indicator gives you the sell signal. The signals are based on breakouts of the lower and upper Bollinger Bands. Here, we're going to look at the lower Bollinger Band, and you can see that, indeed, we had a slight breakout. The problem is that the following candle will completely re-enter the Bollinger Band and will even totally engulf the previous bearish candle. Remember as rule number 1 that to follow the signals, the breakout must absolutely be clear. The market actually needs to break the Bollinger Band and settle below it without re-entering. That's why I'm deciding not to follow this sell signal. So I'll let the candlesticks roll to wait for the next signal from the technical indicator. And you can see here, we have a buy signal with the blue arrow on the chart. Right now, it's much more interesting than before because, as you can see, the market is really settling above the upper Bollinger Band. That means the breakout to happen here is really solid. You also have the red line turning into a green line. So the middle line is becoming bullish. It indicates that there's bullish liquidity, that there's a buying psychology currently in the market. And so you have all the price action criteria and technical indicator levels met to take this buy confidently. The bullish candle given the signal is this one. So we're going to wait for its close because we always wait for candlestick closes to take them into account in a technical analysis. You're going to have to place it at the middle line because we believe that if the market re-enters the Bollinger Band, it's a very bad sign for buyers. And for the target, we're going to aim for a 2-to-1 risk-reward ratio. We let the candlesticks play out and we can see that the market has exploded to the upside. I'll let the candlesticks run and wait for the next technical indicator signal to see if it's worth following by looking at price action, performing a professional technical analysis, and obviously considering the indicator signal. You can see the market completely took off following the bullish signal we tracked earlier. We're staying patient, waiting for a signal from the technical indicator. We can see a sell signal being given by the technical indicator. We actually have a breakout of the lower Bollinger Band with this massive bearish candle, which is a very interesting sell signal. We also have the midline turning from green to red. And when the indicator gives its signal, we're well below the Bollinger Band we just broke through. So even if you see it pull back a bit later, right here in real time, with just these two candles, we enter a short because of the strong bearish volatility breaking the Bollinger Band. It comes back for a retest, giving us our entry price at the close of this 1-hour candle right here. We place the stop loss above this previous market peak because we assume if the market breaks that high, it'll continue upward to test older resistance levels. Now, you have to be patient until the market proves you right or wrong. The market did briefly move back inside the Bollinger Bands, but notice how it bounced off the midline to hit a new low. Afterward, the market formed lower highs and lower lows, which is the textbook definition of a downtrend. So the technical indicator did a great job spotting that sell signal for the upcoming downtrend. I'll let the candles run, and together we'll find the next trade, analyze it, and see if all the signals align to follow the indicator's lead. We can see a buy signal being generated by the technical indicator. You see, the market consolidated for a while after the big drop, and then suddenly we get a bullish breakout of the Bollinger Bands, followed by, remember this is key, the market holding above the bands. You also have your midline clearly turning from red to green. You can even add some extra technical analysis with the break of a bearish trend line. This is the candle that gives the signal. We wait for it to close, which gives us an entry price right here. We set the stop loss and aim for a 2-to-1 risk ratio, just like the previous 2 times.